Okay, to continue our discussion, let me give you some examples on journalizing to posting so that you can be able to integrate these things that I have been discussing in my previous videos. And again, this is part of a series of accounting principles video series, and I have posted the links in the description below so that you can follow my topics. Okay. Diretso na ako sa transaction number 2. Now, second transaction, on October 1, office equipment costing 5,000 is purchased by signing a 3-month 12% notes payable. Now what does it mean? So our basic analysis, what are the accounts affected? Then what is the effect to this account? Okay? So take note that office equipment is here. So you have your asset, office equipment. And what happened? Since you purchased, you increase your office equipment. But you did not pay it, but rather you signed a 3-month 12% notes payable. So that would mean you have a liability account, notes payable. So both of these accounts increased. Now, applying our principles in debit and credit. So what happened if your asset increased? You have to record that in debit. How much? 5,000. So the other one should be credit, notes payable, 5,000. Now if you look at in our journal, so this is a continuation, but I have shown you this transaction only. So you have the date, then the debit is office equipment. How much? 5,000. Now below, you have to write the credit, but you have to indent it first, then 5,000. Then on the next row, you have to write the explanation with indentation once again. So there should be a T account for office equipment and notes payable, right? This is how we view the T account before we'll go to the ledger. So our office equipment has an account number of 15, and you have a debit entry here on October 1 for this equipment, 5,000. And for notes payable, you have an account number of 25 and a debit and a credit entry of 5,000. So if you look at the ledger, this is our ledger for office equipment and this is our ledger for notes payable. And you see you have this account number. So this account number, after we have posted it here, we are going to put it in our journal reference column. So you have the date where that transaction happened of your debit entry for office equipment, and you have your balance. And for notes payable also, you have the date and your credit entry and your balance. So you have seen that this comes from the journal page 1. Now if you look at our journal, the reference column should also be filled up. And what are we going to fill up? This one, 15 and 25 for office equipment and notes payable. So if you can see here, after we have posted the journal entry to the ledger, you have here 15 in the reference column under office equipment and notes payable 25. Now let's proceed with our third transaction, but it's already given, so I don't have to explain it, but it's already given, so let's just explain it. So here on October 2, 1,200 cash advance is received, okay, from James Adams, a client for advertising services that are expected to be completed by 31. So how do you analyze this transaction? This seems to be not yet given in my previous examples. So if you analyze this transaction, Catherine Pania, which is the owner of the business, received a cash advance from James for advertising services that are expected to be completed by December 31. So meaning, the owner of the business, Miss Catherine Pania, has not yet rendered the service, but she receives cash. So meaning, your asset cash increased, and another account affected is your unearned fees. Why do you call it unearned fees? Because not until Miss Catherine rendered that advertising service, she will earn that amount. So at this point of time, the moment Miss Catherine receives that money, it is considered a liability, and we call it unearned fees. And your liability and her liability account increased. Get it? Now, for the debit and credit analysis, you have to apply. What happened if your cash increased? So you have to debit cash 1,200. Now, this is a liability, right? So increase in liability is recorded in your credit. Okay. So let's go to your journal. So what happens to your journal? You have to debit cash 1,200, credit and earned fees with that indention 1,200. So how do you explain it? Received cash advance from James Adams for future services. Again, what makes it a liability account? Because Miss Catherine has not yet rendered the service. Okay? So let's have a T account illustration. So before, you have your cash initial entry of 10,000, right? Now, at this point in time, Catherine receives 1,200 cash, so you have to record it. And another account affected is your unearned fees, which is 28, the account number. So you have to record that under credit, dated October 2. So look at the ledger. So your cash has been added with 1,200. It comes from the journal page 1, the same journal page. So your running balance for cash is now 1,200. No, your running balance for cash is now 11,200. Why? Because from 10,000 you have added 1,200. Now how about your unearned fees? This is a new account. So you have your ledger for this one, dated October 2, initial entry from journal page 1, credit 1,200, and copy that as the initial balance. Now if you go back to the journal, you can see that these account number 28 and 1 are being posted in that particular transaction. So you have cash 1 and earned fees 28. And again, you have to input these account number once you have already transferred the transaction in the journal. No, in the ledger account. So in the next video, I will discuss about how to make a trial balance and what is its purpose. For the journalizing business transactions, I have made a separate video of just the journalizing process, and I have posted the link in the description below. Check it out.